This morning, fresh controversy erupted as the administration of President Donald Trump moves ahead with a plan to introduce 50-year mortgages. The proposal, envisioned as a means to ease upfront monthly burdens on prospective homebuyers, especially younger Americans locked out of today's market, has triggered a backlash from all sides of the housing, financial and political arenas. On the surface, the policy sounds straightforward: stretch the typical fixed-rate home loan from 30 years to 50 years, cutting monthly payments for a given loan amount. It is clearly being pitched as a remedy for what the White House describes as a fundamentally broken real estate market. Yet the details matter, and so do the risks, both for borrowers and for the broader housing economy. President Trump, via social media over the weekend, shared an image that compared his 50-year mortgage concept to the 30-year mortgages championed nearly a century ago under President Franklin D. Roosevelt. In doing so, he signaled the administration's intent to revisit the very architecture of home financing. Shortly thereafter, Federal Housing Finance Agency, FHFA, Director William Bill Pult, appointed by the president, posted on platform X, formerly Twitter. "We are indeed working on the 50-year mortgage, a complete game changer. The administration says the goal is clear: to kickstart the now stagnant real estate market, where homes are seeing their lowest turnover rate in 30 years and where the median age of first-time buyers has climbed to an all-time high of 40. What the proposal does, and what it does not under a conventional 30-year mortgage: a buyer borrowing $400,000 at an interest rate of 6% would face monthly payments just under $2,400. Under a 50-year loan at the same interest rate, the payment falls to just over $2,100, a savings of nearly $300 per month. However, while those lower monthly payments may sound attractive, the lifetime cost of the interest ballooned. The total interest on a 30-year loan would be about $463,000. The interest on a 50-year loan, more than $860,000. These figures assume the same interest rate and full maturity of the loan. This math echoes numbers published by financial media analysing the plan. Critically, the assumption that a 50-year mortgage can be offered at the same rate as a 30-year fixed is highly uncertain. Since no 50-year Treasury bond currently exists in normal volume, pricing such a loan would require assumptions about risk, liquidity and mortgage market behaviour. There is also the issue of equity. Under a 50-year amortization schedule, the homeowner builds equity much more slowly. Far more of the early payments go to interest, meaning after many years the outstanding principal remains high. For example, one analysis noted that under a 50-year term, the first $50,000 in principal might not be paid down for over 2 decades. On the regulatory front, there is a significant hurdle. The post-financial crisis Dodd-Frank Wall Street Reform and Consumer Protection Act, via its qualified mortgage rules, does not currently accommodate amortization terms longer than 30 years for the kind of loans that government-sponsored entities, GSEs, buy or guarantee. That means a 50-year mortgage would either require changes in the law, regulation, or it would have to be offered as a non-qualified mortgage, typically with higher interest rates and fewer protections. Political and market backlash. The backlash has come quickly. On the Republican side, for example, Representative Marjorie Taylor Greene, R. Georgia, posted on X, "I don't like 50-year mortgages as the solution to the housing affordability crisis. It will ultimately reward the banks, mortgage lenders and home builders. Among economists and housing analysts, concern centres on the unintended consequences." One commentary noted, broad government-backed 50-year mortgages would likely lower monthly payments but raise house prices, slow equity build-up and raise default risk in downturns and increase interest rate risk in the financial system. Other critics argue that the product may simply shift costs rather than reduce them. Pushing people into loans with longer repayment horizons may sound appealing, but it does not necessarily address the root causes of housing unaffordability, namely low supply, high construction costs, rising interest rates, and inadequate wage growth. Housing Wire's analysis put it plainly: while the monthly payment drop may appear modest and helpful at first glance, the lifetime cost is steep, and the regulatory constraints mean that widespread adoption may be limited without legislative changes. Why now? What's driving the policy push? From the administration's perspective, the housing market signals are clear and worrying. Turnover rates in the US housing market are at their lowest in 3 decades, and many first-time buyers are delaying purchase. Median age has risen, signaling affordability and access problems. The president has described the market as fundamentally broken right now. By offering a 50-year mortgage, the hope is to reduce the monthly payment burden, thereby opening the door for younger borrowers who otherwise cannot meet the payment thresholds of a 30-year loan in the high-cost environment. Lower payments mean lower monthly debt ratios, which in turn improves qualification prospects under current underwriting rules. Proponents argue that in the context of a persistently tight housing supply and mortgage rates that remain elevated compared to previous years, shifting the amortization structure is one of the few tools available. The FHFA director described it as one potential weapon in a wide arsenal to restore the American dream for young people. But the trade-offs are real. While the headline benefit is lower payments, the trade-offs begin immediately and compound over time. Slower equity accumulation. With a 50-year schedule, it may take far longer for a borrower to own a meaningful portion of the home. In today's market, where many homeowners move or refinance within 10 to 15 years, a long borrowing horizon may render many still underwater when they try to sell or relocate. Higher lifetime interest cost. The longer the term, the more interest paid over the life of the loan, even if the nominal interest rate remains similar. That's because more of each payment goes to interest rather than principal in the early years. Risk of inflated prices. Some analysts caution that by lowering monthly payment barriers, we risk boosting demand without a matching increase in supply. In a tight supply environment, that could simply drive up home prices, thereby undermining the affordability gains. Regulatory and market risk. Because 50-year loans fall outside the current qualified mortgage safe harbor framework, lenders would facing higher risk, potentially higher rates, and difficulties selling the loans into the secondary market. That threatens liquidity and standardization of the product, behavioral and demographic mismatch. Since many homeowners do not stay in a home for 50 years, the structure may not align with real-world mobility. Homeownership patterns, refinancing cycles, job moves, and family changes may make the long-term irrelevant for many borrowers. Interest rate risk and systemic exposure. A proliferation of ultra-long-term loans could alter housing finance risk profiles, especially in a scenario of rising rates or high inflation. As one economic blog noted, increase interest rate risk in the financial system. At this stage, the 50-year mortgage remains a proposal, not a formal policy change. The administration has signaled that the FHFA is actively working on how such a product could be structured, but no final rule or eligibility criteria have been published. Before this becomes widespread, several pieces need to fall into place. Legislative or regulatory amendments to allow government-sponsored entities, GSEs like Fannie Mae or Freddie Mac, to purchase or guarantee 50-year mortgages under the QM framework. Determination of interest rate premiums, if any, for the longer amortization and how that will impact monthly payment savings. Underwriting standards appropriate for the longer term. For example, assessing ability to repay over 50 years, inflation risk, mobility of borrowers, and secondary market liquidity. Evaluation of how the product will affect housing supply, demand elasticities, and price dynamics, because offering more favorable financing could stimulate demand, but without matching supply responses that could raise prices further. Communication to markets, lenders, and consumers about the implications, slower equity build-up, longer exposure to interest rate risk, move and sell behavior, refinancing options, and loan servicing logistics. So what does this mean for home buyers, lenders, and the market? For a younger borrower today struggling with the barrier of high purchase prices and elevated mortgage rates, the 50-year term may appear as a tempting bridge to home ownership, a way to get into the market with a lower monthly payment. On the other hand, borrowers need to weigh carefully whether the lower monthly cost is worth the slower accumulation of equity, the higher total interest cost, and the potential mobility-oriented risks of staying tied to a property for far longer than planned. For lenders and the mortgage finance ecosystem, the shift would require adjustments in underwriting strategy, risk modeling, and secondary market structuring. The standard 30-year fixed remains the dominant benchmark. Stepping outside that architecture raises questions of liquidity, resale, pricing, and servicing. For the broader housing market and economy, this move signals how acute the affordability challenge has become. It suggests that policymakers are considering structural changes to mortgage finance as a lever to restore access. But it also raises the question whether finance reform is treating a symptom rather than the disease, namely the mismatch between housing supply, price escalation, wage growth, interest rate environment, and broader macro affordability dynamics. President Trump's administration is pushing ahead with the idea of 50-year mortgages, a bold and novel approach aimed at lowering monthly payments and enabling access for younger buyers. But as the numbers and analysis show, the policy comes with meaningful caveats: higher lifetime interest costs, slower equity growth, regulatory hurdles, and possible unintended market consequences. As one expert put it, this could be a complete game changer, but only if its mechanics, risks, and market effects are carefully managed. Whether this becomes a mainstream mortgage option or remains a niche experiment will depend on how swiftly the legal and regulatory obstacles are addressed, how lenders and borrowers adapt, and how the housing market responds to the added demand this product might create. For now, the nation's housing finance system and prospective homebuyers are watching closely.